If you have any interest in options trading, then you've probably heard of the Greeks. The Greeks are financial metrics that traders use to measure factors that affect the change in the price of an options contract. We will start off with delta. Delta measures an option's price sensitivity to a $1 change in an underlying asset. Call options will have positive delta, because when the underlying asset's price goes up, the call option's price will also go up. Whereas with put options, if the underlying price goes up, the put option's price will fall. Let's dive into an example. Imagine that there is a call option underlying a stock. This call option has a delta of 0.5. The call option currently has a price of $4. Now, if the stock's price goes up $1, then the call option should go up by 50 cents, and the final call option price will be $4.50. However, if the stock's price had fallen by $1, then the option's value would also fall by 50 cents, and the new option price would be just $3.50. But what if we were looking at a put option? Like I said before, put options will have negative delta because their price moves with a negative correlation to an underlying stock's price. Now, let's look at an example where a put option has a delta of negative 0.5 and an original put price of $4. If the underlying stock's price goes up $1, then the put option's price will fall by 50 cents, and the final put option price will be $3.50. But what if instead of the underlying stock price going up $1, it actually fell $1? Well, then our put option should become more valuable. In that case, the put option's price would go up by 50 cents, and we would have a final put option price of $4.50 because of that negative 0.5 delta. Let's look at an example of a call option with the underlying of the largest S&P 500 ETF, SPY. Now, this shows about 2 months of the SPY's price movements over time. And you can see that a call option with a positive 0.75 delta on the SPY tracks the movements quite well. There is a high positive correlation between the prices of both the stock and the underlying call option. The difference, however, is that the call option has a greater scale by which the price moves. So you can see that over the course of this 2 months, that while the stock price went up roughly 30%, the call options price actually went up almost 300%. Now let's take a look at a put option. The put option behaves the opposite of a call. Here we've got a put option on the SPY with a delta of negative 0.75. You can see that when the stock's price rises, the put option's price falls. And you can also see that the put option's price changes by a greater percentage than the percentage change in price of the underlying stock. That is because, in general, options are quite a bit more risky than trading just the underlying stock. Let's introduce a practical example that can be useful for options traders. Option delta is often informally thought of as the probability that an option expires in the money. And now we're going to look at an example of how option delta will change as an option approaches maturity. In this example, we're going to be looking at an in-the-money call option that has a strike price of $35 and a stock price of $40. Now, what does that mean? That means that if I own this option, I can buy a stock for $35 that's actually worth $40. So I am currently in the money because this stock or this option will exercise and I will have value when it exercises. Now, all of these deltas that you're going to see on this graph, assume that that underlying stock price and the strike price are held consistently over time, and we use the Black-Scholes pricing model to price the deltas. And that's beyond the scope of this video, but I have a handful of videos on Black-Scholes option pricing in both Excel and Python if you're interested. Now let's take a look at the graph. So what this shows is that as there's 60 days to expiration, this call option is going to have a delta of about 0.96, which means that there's roughly a 96% probability that this option expires in the money. It also means that if the underlying stock price goes up $1, our options price should go up by about 96 cents. And then we see as the days to expiration change, the probability that our option expires in the money increases and increases and eventually approaches about 100%. Once we get to 0 days, we're going to have about 100% probability that this option expires in the money. And then every $1 change in the underlying stock price will be met with a $1 change in the underlying options price. Now let's take a look at an out of the money call option. Now what you are seeing on this slide is exactly the same as the previous slide, except we've changed one thing. The call is now out of the money because the strike price is $45 and the stock price is $40. This means that we would have to buy something that's worth $40 for $45, which we would not do, and so it's out of the money. Now, if we look at the graph on the left side, so the delta for an out of the money option, as the days to expiration approach 0, when there's 60 days to expiration, the delta is at about a 0.08, which means that there's roughly a priced in probability of an 8% chance of this option expiring in the money. And you'll notice that this is much lower than the in the money example previously. That's because when the option is out of the money, there's obviously a lower probability that the stock price will exceed the strike price at the time that this option expires. And now we can see that as the days to expiration goes from 60 to 0, as it approaches 0, the probability that the option expires in the money will decrease and decrease and decrease, which means the delta will decrease and decrease and decrease. And then once we get down to near 0 days, there is a near 0% probability that this call option will expire in the money. And hence, if the stock price were to rise by $1, we would see virtually no change in the option price because it's just so unlikely that this option expires in the money. Let's look at a visual that I believe will bring everything together. This graph shows the deltas for calls and puts at different strike prices. We're going to assume that the underlying stock has a price of $40. We can see this marked by the green line. Now, the vertical axis shows the deltas. The horizontal axis shows various strike prices. We can see with the blue line that this is the line of various call deltas at different strike prices. You can see that there is no point on this blue line where the value is anywhere between 1 and 0. You can also see that as the strike price is lower or closer to 20, that call delta approaches 1. This is basically showing that as the stock becomes further and further in the money, meaning that the strike price is further and further beneath the stock price, the probability that the option roughly expires in the money approaches closer to 100%. This also indicates that for each dollar move in the stock price, we should see roughly a $1 move in the option price. And then as the strike price approaches the actual stock price of $40, we should see the call delta blue line approach 0.5. Typically, when a option is near the money, meaning the strike price is near the stock price, the option's delta will be around 0.5, and there's about a 50% probability roughly that the option expires in the money or out of the money. And then as we get further and further out of the money, meaning that that strike price approaches that $60, the option delta approaches 0 because the probability that the option expires in the money gets lower and lower and lower. Let's take a look at the orange put delta line. It is going to be the reverse of the call option delta line. So a put option grants me the right, but not the obligation to sell a stock at the strike price. So if we use a strike price of 20 as an example, if this underlying stock price is $40, then I am not going to be interested in selling something that's worth $40 for just $20. And hence the put option is actually deep out of the money when the strike price is near $20. And that's why we see at the $20 strike price, the put delta is near zero. At that point, there's also a near 0% probability of the put delta or the put option expiring in the money. But as we increase the strike price, we see that once the stock price of $40 matches the strike price of $40 as indicated where that dashed green line crosses over the orange line, we should see a near negative 50% delta, which indicates a near 50% probability that the option expires in the money. And then as the strike price gets higher and higher and higher, and we approach $60, the put option actually gets deeper and deeper and deeper into the money, and the put delta should get closer to -1, indicating that there becomes a closer to negative or closer to 100% probability that this put option actually expires in the money. And that would indicate that for each $1 increase in the stock price, there should be a near $1 decrease in the put price. Thank you for watching this video, and be sure to check out my website, RyanO'ConnellFinance.com, where you can find help with financial modeling or financial tutoring. And also feel free to check out some of my other videos on options pricing or options trading that you can find here or here. Thank you.